Hey everyone, it's Eric Green. Want to say hello to everyone in our tax rep community. And I want to talk to you about our sponsor, Call ENQ. And I'm going to just say this, we would not take any sponsor or any product that we do not use ourselves. If you listen to episode 36, Dialing for Dollars, I discussed kind of how we discovered this. It is amazing. It is literally changing the way we practice in our office, right? What Call ENQ does is, you're sick and tired of waiting, right? 30 minutes, 45 minutes, an hour. You finally get through to the IRS. Their system is down. They can't help you. Sometimes they just hang up on you, which is always fun. And then you have the problem is, do you charge the client for this or do you not, right? It's not the client's fault. On the other hand, it's not your fault. Call ENQ says they will get you through to the IRS in under 3 minutes. We are averaging 30 seconds. When we talk about saving in our business, time is money, right? We think projecting now for the month we've been using this, if we project to a year, we will probably save $50,000 of billable time, right? That is a lot of money that we'd love to have fall to our bottom line. And I'm sure our clients would rather not pay for. So with that, I'm going to put a link below. Go check out Call ENQ. It is a fantastic service. And I'm telling you, we negotiated for ourselves to get a free 100 minutes as part of our deal with them. All of our tax rep members will get 100 free minutes. You can check it out. You have nothing to lose and a lot of time and money to gain. All right, go ahead and check it out. Log into the forum. Let me know what you think. All right, everybody, it's Eric Green. Thank you for joining us again on this week's Tax Rep Network. I'm really thrilled to have my guests on that we have on this week. As you know, or probably know, there's been a lot bandied about in the media about Jared Kushner and Donald Trump and the fact that they may or may not be paying taxes. Well, there's a legitimate reason for that, and there are lots of advantages to real estate. And in particular, there are things that real estate investors do which not only gets them their money back faster, but can be used to shield income perfectly legitimately. And so I'm thrilled, the timing just worked out really well to have on Chuck Tover and Yona Weiss. Yona is a friend of mine. They are at Madison Specs. Now, Madison Specs is a branch of Madison Commercial Real Estate Services. It is one of the national leaders in cost segregation. And if you don't know what that is, don't worry, we're going to get into that. All right. Over the last 12 years, they've conducted over 13,000 cost segregation studies in all 50 states, including close to 2,000 in 2018 alone, year to date, and we're not done yet. All right. What has that resulted in? Over $3 billion of tax deferrals. So if I haven't gotten your attention before, I bet I got it now. All right. Madison Specs has an experienced team of 50 in-house engineers, accountants, and tax experts who work exclusively on cost segregation studies to ensure that clients obtain the greatest tax benefits from their real estate holdings. They make accountants look like rock stars, enable their clients to maximize depreciation deductions, and save a lot of money. So again, Chuck, Yona, thank you for joining us on the program. Now, just so for those listening, Chuck is a CPA and he's the director of tax for Madison Specs. And Yona is a powerhouse in the property owner's tax savings world, which is how I met him. Actually, Yona, through LinkedIn, I think actually you and I is how we originally connected. And as I would run into accountants and this topic would come up, inevitably I would get referred back to Yona. I'd be like, yeah, I know Yona. So gentlemen, listen, thank you for agreeing to be on the podcast. I think the timing couldn't be better. So you know what? I think nothing to it but to do it. Let's just jump into this. Sure. Real estate is one of those investments that has many benefits: passive income, capital appreciation, and an ability, as I mentioned earlier, to shield income from current taxation. Basically using the concept of time value of money to make the owner even more income. Right? I mean, again, I threw out there, only because they've been in the headlines, Jared Kushner and Donald Trump. But for those folks, and again, most of our listeners are accountants, but for those folks who do hear this and are unfamiliar, with the concept. Can you just explain? Let's step back. What is a cost segregation study?
Sure. Well, thanks so much, first of all, Eric, for having us. Chuck and I are delighted to join you, and we love doing these kind of things. So just jump right in. Yeah, depreciation is something that everyone knows about. Okay, it's a tax write-off based on the value of the property, right? So what we do, cost segregation, is a detailed engineering-based study that allows you to accelerate depreciation deductions, meaning taking certain values of the property that depreciate over faster lives, as opposed to a straight line, which for residential real estate would be 27.5 years, commercial real estate over 39 years. Instead of taking just a normal deduction each year, we can, through engineers, like I said, break down the property into minute details and how much each of those assets, these details, are valued at, and get those depreciation deductions in the early years. So within the first 5 years is a big amount, because a lot of the property is broken into what's called personal property, which is a 5-year asset class. And there are other asset classes like 7 years, and 15 years is the biggest other one, which includes land improvements, landscaping, pavement, curbing, signage, fencing, all kinds of stuff that's outside the building. So that is what a cost segregation is. A weird name, okay? Segregation, right? Everyone gets, what's segregation? But we care about real segregation, right? Which is cost segregation, because tax lives matter. And that's really important to remember.
Yeah, I mean, again, if you're listening to this, so, you buy a commercial building and you own it, it's what, 39.5 years would be normal straight line depreciation?
39, yeah.
Yeah, right. So I go and it's right, it's 27.5 if it's residential. So 39 years. So I buy this building, right? $1 million, let's say 100,000 is real estate, 900,000 is the building, divided by 39, and I'm done. What you guys do, and by the way, it's key. You need to have the engineering report that backs this up. In other words, I can't sit there myself. Say, you know what? I think the windows are worth X, and I think the plumbing is worth Y, whatever. You guys will go through with an engineering report and say, you know what, Eric, your building is not 39 years of building. There's, as you said, of that, let's say 900,000, maybe 200,000 of that is really 5-year personal property. And other stuff might, what you do is, if I'm following and my understanding of it is, you carve this up. And if you're listening saying, okay, well, so what? Well, so what? I'd rather get the 200,000 back over 5 years instead of spreading it out over 39. So you get to accelerate that and effectively get your money back faster than you would just divvying it up over 39 years.
Right. Yeah, exactly.
So you mentioned the engineers. So can you walk us through what does it entail? What does a cost segregation study entail? I mean, if you can, for those folks who've never been through this process, can you kind of walk through kind of what this looks like?
Sure, absolutely. And what the process is, Eric, you nailed it. You really nailed it on the head. The kind of general methodology is, okay, you estimate your land value, you take the rest over 39 years or 27.5 years if it's, let's say, an apartment building. And what some people try to do is, okay, they estimate. And I call it, kind of throwing a dart against the wall, kind of what you said, and say, well, I estimate my carpeting is X, or my 5-year property in total is again, maybe 150,000 out of that 900,000. And the IRS really frowns on that kind of methodology. And what we do, we actually follow the IRS playbook and give them exactly what they want. Is they want a qualified person, so not necessarily a CPA to go walk the property, but an engineer who doesn't only understand construction, he also understands the tax treatment of certain items. And just to give you some examples, it might be cabinetry, it might be certain kinds of tiles on your floors, it might be the electrical capacity of the building, which is a really interesting topic I'll talk about in a second. And they quantify all this using IRS approved methods, IRS approved cost standards, and come up with, here's what the 5-year property is in this particular building, or here's what the 15-year land improvement property is. And all our study, 100% of our studies, an engineer goes out. We have an engineer go out. We have I think, engineers all over the country, every region of the country, and they go out and they walk the properties. And whether it's an apartment building, whether it's an office building, industrial, retail, whatever it is, they will walk that and identify it. And what our report will do is we'll identify those components or those pieces of the property that qualify for 5-year treatment or 15-year treatment, and quantify those and isolate those. In addition, what our studies do is we actually will give what we call the tax justifications as to why that property qualifies as 5-year property. And, well, why are floor tiles? Well, because in such and such a court case, the IRS tax court or this court ruled that this is property. We really justify virtually every asset that we identify. We justify it with an IRS-backed, either IRS tax court or IRS regulations, which justifies the treatment of this property. But what you said is exactly correct. It's the cornerstone, and it starts with the engineers going out and walking the property.
Yeah. So, and I love the fact that, when like you said, you're basically following the IRS's playbook. So at least from that perspective, it would be difficult for the government. And listen, I mean, what I do for a living is fight with the government. And so there is a beauty to the idea that, why do you do this? Well, you told us so, or the court told us to. Right. And you start, at least you've taken that off the table. But out of curiosity, do you find that these sorts of studies raise flags with the IRS?
We haven't found that the study itself raises the flags. What we have found is if some of our clients are getting, if their returns are being examined for other reasons, and then the auditor might say, oh, okay, so you took some depreciation. Give me the backup for these depreciation numbers. Usually it's not, from what we're seeing, that's not usually what's triggering it, but once the returns are already getting looked at, the IRS will ask for them. And what we turn over, what our clients turn over, is basically a report that's anywhere from 80 to 120 pages long. And it quantifies the assets, it lays out the asset values, it gives the tax justifications. We have pictures of the properties to show we've actually been there. And it's all done in accordance with their guidelines. Once they get that, it's like, okay, and again, I use the same metaphor. There wasn't some guy sitting in a room throwing a dart, or a woman sitting in a room throwing a dart against the wall, estimating this. We're an outside third party. Our fees are fixed fees up front. We don't have success fees. It's the old, let's say, property tax assessment appeal stuff where they get a percentage of the savings. We don't work like that. We're fixed fee. And those are the things the IRS likes to see. Okay, so an expert who understands construction and the tax rules went out. Great. They don't have the percentage relationship in what's achieved. They're an outside party. They're expert. So we kind of check the boxes, and all of those things help reduce any problems. And our track record, frankly, is, so far, our track record is we've had no changes on any of our cost seg studies that have been reviewed by the Internal Revenue Service or any other tax authority.
Well, and I can tell you, having gone through this where people have either tried to back of the napkin do it themselves, or where they've donated property and don't get the timely, qualified appraisal. What I have found is exactly that. If we have had someone who did that, right, had the cost seg study done by a professional, had the appraisal done by a professional, and you submit that, I do find that problem goes away pretty quickly.
Absolutely.
It's where we don't have it. Now it's almost like now you're inviting the government to begin inspecting it. And now you're fighting about everything, right? You're fighting about, this and that. And those are the cases that end up becoming, and I got to tell you the truth, I've had this where, people will start balking at the fees, and my law partner, Jeff, or I, or one of our other litigators here, Lisa, Larry, whoever, will say, look, you can save that fee now, but just know when you get audited, you're going to spend that or more fighting over this.
Right.
It is in many ways, not just the time value of the money at issue, but in the insurance aspect of it, it is really sort of a from my perspective, it's sort of only, and again, because I see where the outcomes can fall out, it really is kind of a no-brainer. So are there particular types of property that lend themselves to a cost segregation study, let's say more than others?
Well,
Go ahead, John.
Yeah, just to reiterate what you said before, to answer that question, Eric, there is something called the Cost Segregation Audit Technique Guide that the IRS put out, which in it has 13 principal elements needed for a quality cost segregation study. So it's not just enough to know that there exists Section 1245 property, right, that you can depreciate over 5 years and kind of come up with a number. It's important to follow this guide. And so just to reiterate that, we follow that guide, and most, the firms out there that do this do that. So getting back to your question, what type of properties qualify more? So the more personal assets within the property, the better, benefits are going to be there. So we talk about, any type of property we've seen really has benefits. Any commercial property, whether it be, retail or hotels, multifamily properties, you name it, really have benefit there. But things like skilled living facilities, skilled nursing facilities, have actually a very high percentage of 5-year property. You're talking about, the equipment in every single room, the electronic equipment, beds are very costly, and there's a lot there. So that's one of the ones that, has a high percentage, but most properties will have 5-year property anywhere between 10 and 25 to 30% reallocated to those kind of lives. But on the flip side, just to tell you about something that people don't realize so much, which is something, just an example I love to give, which is golf courses. Because golf courses, people think it's just land, right? And land is not depreciable. But actually, golf courses are pretty much all land improvements, meaning it's 15-year property. So you can accelerate almost the entire amount of that property from 39 years to 15 years, which is pretty amazing.
Yeah, as we're sitting here thinking, we have a lot of people here that buy older farmhouses. Probably not a good one, right? No, there's not too much personal property there. However, you're right. I mean, any kind of a building where you're going to have HVAC and you're going to have windows, you're going to have carpeting and flooring and everything else. No, I absolutely do follow it. Now, does this have to be done when you buy the property, like at that moment? Is it something that you can do after the fact? In other words, what I'm thinking is, are there people listening to this saying, "Oh shoot, you know what? I never mentioned this to my client. He bought a building a year ago, 2 years ago." How can you do it after the fact, and how long after the fact?
That's a great question. It's a pertinent question. And the answer is, you don't have to do it in the year you purchase it. You don't have to do it the minute you purchase it. You can go back really almost as much as possible. What we see economically where it makes the most sense is anywhere from 2 to maybe 7 or 8 years back. And then what happens is the engineer reviews the building, looks at the building, and we come up with our percentages, and we say, okay, had the cost segregation study been done in the year of purchase, the depreciation taken from that point of time to the present would be X, as opposed to what was actually taken when it was, let's say, a commercial building over 39 or an apartment building over 27 and a half, to what was actually taken. And you can actually take that difference as an immediate lump sum deduction in the year that you do the cost segregation study. And what makes it even more interesting, and if the bulk of your audience is accountants, they're going to be really hip to this, is you don't need to do an amended return, because no accountant ever wants to file an amended return for a lot of reasons, and a lot of good reasons. But you do this through a form, it's called an automatic accounting change. You file with a form 3115, and there's no amended return, which really gets a lot of people excited about this. So, so your question, like I said, is right on, in that, no, you don't have to do it in the year you purchase it. You can do it later, and sometimes it makes more sense to do it later, because very often, if people are active real estate players, they may be going in and taking a building that isn't in such great shape, either physically or maybe it's got a vacancy problem. So maybe in that first year or two of ownership, it may not be generating a lot of taxable income anyway, maybe through interest expense or just vacancies or repairs. So they make, the last thing I need right now is another tax deduction. Then they turn the property around, they reposition that asset, and 2, 3, 4 years in, now they're generating a lot of income, certainly a lot more than from when they bought it. And now you do that cost segregation study, generate an immediate deduction from what you didn't take, as well as some higher depreciation over the next few years, and really shelter or shield, as you said, a lot of that taxable income.
Interesting. So it's not even it's not even so much that you can't do it afterward. You can do it afterward, and in doing so, there may be actually an advantage to waiting if you're going to be doing improvements too and whatnot.
In certain cases, sure.
Yeah, I hadn't even thought of that. And clearly, I was going to ask you about how it does improve cash flow, but I think you've already hit on that, which is we get the deduction now, reduce our tax now, and shield that income coming back. Hence saving taxes and again accelerating the amount of money we can get back from our purchase. I'm trying to think, is there a downside to doing a cost segregation study?
I think the downside is if you don't need the deduction, it's probably not the right time. It's a timing issue more than anything.
Yeah, no, I follow that. Now,
there's also obviously, just important to hit the note. There's also, depreciation recapture, but when we're tax, which obviously is a downside. If you're taking more depreciation up front, you may get hit with more tax on the later and upon sale. However, if you're not doing a 1031, that is. However, like you said, it's really an issue of the time value of money more than anything.
Yeah, no, I got to tell you the truth. It makes me crazy when people. There are two things that make me crazy that accountants do. Don't take it now. You'll have more basis later, which I've heard. Why does that make sense to anybody? I sit there and I want to scream and go over the table at them like this is finance 101. I mean, this is. I would rather have $1 now and pay $1 back 3, 5, 10 years from now, right? Because of time value of money, inflation, all the rest. The other thing that makes me crazy has nothing to do with this. It has to do with when they have people go spend money at the end of the year to create deductions.
Right.
I don't understand why anybody thinks that's a good. Now, if you needed stuff, right? If you can accelerate it from January into December, then obviously, I mean, that makes time value of money makes sense. But to go spend money to get, let's say, 30 cents back, what I'll tell clients when they tell me this is, look, you tell your accountant that's idiotic, but if you're really stuck on this, you give me the money and I'll give you 50 cents back. And they'll look at me and they'll be like, yeah, this is idiotic, right? I'm like, yeah. But you did hit on something which is interesting. How has the 2017 Tax Act, or does the 2017 Tax Act impact any of this? I'm thinking bonus depreciation. I mean, is there any impact to what's happened now, or will any of the law changes now impact cost segregation studies one way or the other?
Absolutely.
Yeah, there's a lot. There's been a lot going on. Yeah, no, there's a lot going on regarding that. You hit one of the big ones, which was bonus depreciation. And what bonus depreciation used to be was in an effort to kind of spur the economy. And this is very common that the government, that Congress will try and use the tax code to spur various economic activities. But one of the things the tax code allowed was that if you did new construction, so you had your people were working in construction, you're buying materials, employing people, and there was activity going on, you were able to take an additional depreciation, or what's called bonus depreciation, of up to half of that amount that you spent. So if you had a property, it may have been 5, 6, 7, 8 years old, whatever, and then you did a major renovation, and let's say that renovation might have cost $1 million. And within that $1 million renovation, maybe you had $300,000 of 5-year and 15-year property. you could have taken up to 50% of that as a one-time deduction called the bonus depreciation. Under the new tax law, two things happened. Number one, that 50% jumped to 100%, and the property eligible didn't have to be new construction property. The wording was property that had never been placed in service before by any taxpayer. And now you can buy a property you can buy a 20-year-old apartment building and identify the 5-year property and get up to 100% bonus depreciation on that, and which is a huge boon. Which is really good. And you hit on a bigger point also. There's there's a lot more what I call depreciation tax planning going on based on the changes in the tax laws. 100% bonus is just one of those items. There's flow-through percentages, carryover percentages, depreciation method percentages, interest expense limitations. There's all kinds of things going on that make cost segregation very relevant and really can tailor to each person's tax needs. And it's actually it's a real interesting time. And it's there's just a lot going on, and there's a lot the new tax. And I've talked to accountants a lot. I'm a CPA myself, and I talked to a lot of practicing CPAs with clients. And I was with a big fund last week, and there's like 6 people in this meeting, and the tax director, and they're like, we're all still waiting for some better guidance from the Internal Revenue Service on what's going on with this tax act. But there's a lot happening in regards to depreciation, in regards to real estate in general. And cost segregation can really, play a big part in justifying some additional tax deductions just based on the new tax law.
Right. Yeah, to sum that up, it used to be just for new construction, the bonus depreciation, but now it's for any new acquisition, which is really the biggest game changer.
Yeah, no, it sounds like it. So if somebody is sitting there listening and thinks this is the most brilliant thing they've ever heard, can you give us a sense on what a client could or will probably should plan on spending on something like this?
Yeah, well, I mean, the big firms that have engineers on staff are still charging what they used to charge 10 years ago, which is a good $10,000-$20,000 at least for one of these studies. But our firm is, everything's in-house. We focus solely on this. So generally speaking, it's around $4,000, $5,000, $6,000 for properties. Again, it really depends on the scope of work. So larger properties, more square footage, bigger type of properties are going to be more. But rarely, we hit the $10,000 threshold. I'm talking about, and we've done a number of, million square foot properties and stuff like that. And we're, rarely reach that threshold.
Yeah, no, I mean, 4,000 to 6,000. I mean, no offense, it's a no-brainer.
Yeah, I mean, when you're talking about hundreds of thousands or millions of dollars of tax benefits,
savings,
it's a no-brainer.
I mean, and so I was going to ask you, but is that really what sets you guys apart, that you have people in-house, this is all you do? I mean, what is it that makes Madison Spec, different than, like you said, the other firms out there doing this?
We are, one of the leading companies doing this, meaning we have so many studies under our belt, and coming from experience with our CEO and Chuck and a number of the other accountants on staff who have Big Four experience, and coming with the industry expertise, and at the same time to couple that with really, I'd say, an entrepreneurial spirit, because so we understand what investors and a lot of real estate investors are looking at, and so we're there. Like, our service is probably second to none, and that really, I think, sets us apart more than anything else. Which, just to give you an example of that, if, like Chuck mentioned before, if someone gets audited, which no one wants, we're there 100% to stand behind our work, and we will do that in the face of an audit. So that's something that I don't know if everyone can hold to that, but we definitely do.
So, what's the largest job that you guys can think of that you've ever done?
Oh, this is great. This is one of my favorite topics because we've done so many. In fact, I think we did the Rochester Tech Park a number of years ago, which I think is the largest commercial property in the United States. It's over 4 million square feet of office and industrial space, and miles upon miles of parking lots and roads and pavement connecting them. And that's probably one of the largest properties, but we've done a handful of billion-dollar plus acquisitions. So you're talking skyscrapers. We did a really large 3,000 unit multifamily portfolio in San Francisco, which is definitely over $1 billion purchase price on that. And, like I said, done a number of skyscrapers both in Dallas and Philadelphia and New York City, all over.
And because you guys are all over the country, I mean, you do work everywhere.
Yeah.
All right. So before I ask my last question, let you guys go. How is it that our listeners, if they want to, can get a hold of you?
The best way is to reach out to me, like you did, Eric. LinkedIn is something I'm active on pretty much daily. It's a great place to find me. Madison Specs. You can put my email, my phone number in the show notes. yweiss@madisonspecs.com, or my number is 732-298-9002. I'm kind of on the business side of things, so helping clients and accountants alike, making sure that they get the best tax benefits.
No, and I will, if you're listening, I will put all of Yona's contact information, the number, everything in the description below. All right, so guys, last question. What's the most interesting cost seg study that you've ever done? Not necessarily the largest, but do you have any of those kind of, beyond the normal borders of the page kind of stuff?
We did a winery recently, so that's always fun. And there's a lot of equipment and a lot of, as Yona mentioned, landscaping and depreciable land improvement property. So the wineries are always kind of cool. I think the engineers all fight to go on those kind of studies, to do those kind of site visits.
The free tasting afterwards.
Usually there's a sample floating around out there.
The winery must have been interesting.
Yeah,
it's unusual.
But yeah, factories are all types of factories. And we did also a brewery. We did a distillery out in Colorado also this year, which whiskey distillery. So that was also pretty interesting because the equipment, again, there's so much equipment inside there.
Right.
Those are always fun. And hotels, those are big ones. But
yeah, hotels are real interesting.
I think, important notes, obviously the tax benefits are for everyone, but generally speaking, we recommend any property purchase for over $1 million. That's really the starting point where you're going to see, significant benefit. Under that, it really usually doesn't really make sense, although some people want to get whatever tax deductions they can, just that's kind of our policy.
Yeah, no, I understand that, because both to justify it, but also to make it worth your time. Right. I do know. So listen, thank you. This has been very interesting, and I thought I really knew these. I had a handle on cost seg studies, but it's pretty interesting stuff. The 2017 Tax Act impact, I think, is huge. And given that our president does have an affinity for real estate investing, I'm sure that wasn't lost on him. But
as does most of Congress.
Yeah, well, listen, I mean, the real estate industry is a big driver of everything, right? Banking, yes, lending, construction jobs, and everything that kind of goes with it. So it's why real estate in this country is so preferred tax-wise, and it makes sense. I mean, it is a driver of a big chunk of the economy. All right, so listen, guys, thank you for joining me, and everyone, thank you so much for listening in on this week. Again, if you want to get a hold of Yona, I will put his information down below in the podcast description. Otherwise, keep listening, keep working on your practices, and have a great day.
Thanks again, Eric. It was a pleasure.
Great. Thank you, Eric.
Hey, everybody. I hope you enjoyed this episode of Tax Rep Network podcast. Listen, there has never been a better time to build a representation practice, right? The 1040 business is not a growth industry right now. With more than 14 million accounts in the collection division inventory and more than 7 million non-filers that the IRS has identified and going to begin going after, this is the time when your skills are needed. Worried you don't really know what to do, think you need training, think you need coaching, think you need somebody to back you up. That's what Tax Rep is, right? Come join our community, begin building your practice, make more money, add 100,000 or more to your bottom line, and know that you've got us watching your back. You have questions about a case, issues with marketing, how to market, you want to use our marketing materials. It is all there for the members in our site. All right. So come check us out. We'd love to have you join us if you haven't already. Right. Keep building on your practice. Keep helping taxpayers. Have a great day.